I made over $35,000 in 30 days, and I wouldn't have been able to do it without market structure. So in today's video, I'm going to share with you my 5-step blueprint to mastering market structure. And when you're done with this video, I'll link a new video in the description that will show you how you can go from where you currently are to profitable trader. And as a bonus, in this video you're watching right now, at the end, we're going to tie all 5 steps into a step-by-step trading plan and a step-by-step trade breakdown. Now, the first step is true market structure. This is how we're going to actually identify consistently the highs and lows that we're going to use to give us our directional bias. It's very, very simple, and it's only going to get more advanced from here, so pay attention. How we start is we're going to map out our external points of market structure. You see here, this high right here represents the external of the price leg. You have one bearish move, and then in that move, you have a high and a low. Those represent your external levels of structure. So you can mark this as your high, you can mark this as your low, then you need to go and find your next, which is this high, and then the next, which is this low. Now what we can see here is this high to this low, and then this high to this low. This high to this low is lower than the previous high to low. So we have a lower high and a lower low. When you have a lower high and a lower low, this simply represents bearish price delivery. This simply means that price is trading lower and is likely to continue to do so. So from there on out, it's about waiting for a pullback like this, identifying your next high before then getting the continuation with another break of structure, giving you another lower low, following back up with a pullback, gives you a high, and then a continuation, which is a break of structure and a new lower low. So to recap, to identify true market structure, we need to identify the external swing points because those are going to tell us whether price is trading lower or price is trading higher. From here on out, we can go and take a look at this in a bullish example. So here we have the exact same thing. And very simply, we're just going to map out our low to our high, higher low, meaning this low right here is higher than the previous one, break of structure, higher high, higher low, higher high, higher low, and higher high again. This symbolizes bullish market structure. In essence, price is trading higher and is likely to continue to do so. That is one of the biggest parts of market structure. It's going to give you an insight on what's going to happen next so that you can get involved when that move comes. Next, I want to walk you through the change of character. Essentially, the change of character is moving from one side of the market to the other. So if we look at what we've just learned and we apply that, you can see that we have a swing high up in here, a swing low down here, we pull back for a lower high, and then we go lower low. So right now we are bearish and it is confirmed. That is our break of structure. Then we have a pullback, lower high, and continuation, break of structure, lower low. At this point in time, you're essentially betting that price is going to continue trading lower, but sometimes the market structure will shift. This is what we refer to as the change of character. When you see a swing high that is in control of the current market structure, meaning that this is the high that puts in the most recent swing low, when you see that level get broken, that is what we call a change of character. Simply put, the market is now shifting from bearish and it could be shifting to bullish. And so then you can see we have a higher high, a higher low, and then a new higher high, giving us another break of structure. So from here on out, we'd essentially be expecting that the order flow from here would be to come back into this level and then continue higher again. That is how you would build your expectational order flow. In step 2, I want to walk you through what I refer to as the trap. And this is where things get a little bit more advanced. You see, the trap is essentially the difference between internal and external market structure. And this is the biggest problem that you're probably currently facing right now. You see, what we're going to do is we're going to apply what we just learned. So we're going to try to find our true swing points. We can do that by marking out the low to the high, the new low, the next high. That is bullish structure. That's a break of structure to the buy side. From here on out, this is where things get a little bit more complicated for many traders, because what happens is price puts in this high, and then it puts in this low, and then it puts in this next high, and then it puts in this new low. Now, the key here is to understand that our true market structure is from the low down here to the high up in here. Anything that is inside of this low and this high until it has been broken is internal. The problem that so many traders face is they try to use the internal as external without even knowing it. So what happens? We put in a new swing high. Price begins to trade down. We come up, we trade lower again. Well, many traders may perceive this as a bearish break of structure. And the mistake that so many of them will make is they will now try to short the market from this new level. They'll try to put their sell in here, their stop loss is up in here, only to find out that it eventually hits their stop loss because they were trying to trade against the market direction and unknowingly to them. So what you need to be on the lookout for is always make sure that you have your true low and your true high, and understand anything inside of that is internal. So don't let it trap you, because what a lot of the times you'll see is price will do this, lower low, lower high, lower low, back to higher high, higher high again, and then eventually giving you the actual external break of structure to the buy side up here. This being our real break of structure. From here, it's simply finding the next true market structure. To do that, we want to understand where price has broken out from. So if this was our high and that gets broken, and this was our low and that gets respected, our new high is obviously here. To identify our old low, we should draw a box from the high up in here to our low down here, and then bring it across until we get a break out of that box. Well, now what you have is your internal price range. And so everything in this gray box is your internal structure until we break out. Once we break structure up like this, then we want to go and locate the lowest point that price came back before breaking structure. So if we broke structure here, anything inside of this box, find the lowest point. In this scenario, it would be this low right here. This low right here becomes your new true swing low. And so what we can do is we mark this out like this as our swing low, and then we mark this out in here as our swing high, and then we have our new true market structure. For then price to come back again, have a pullback, and then have a continuation. Again, another area where many traders go wrong is they will see this. This should be your low, this should be your high, but what they will see is that price pushed up, come back, broke structure, and then when price comes back down in here and breaks this low in here, they think we've shifted bearish. And so what do? They flock to the market, and then they try to go short. They put their short positions on, they put their stops above the highs, they wait for price to come back after breaking structure, and then they try to sell on the retest without really understanding that the true market structure was always bullish. They were just falling for the trap, which is the internal structure. Now let's move on to step 3. And this is what I refer to as the real problem. What I've just shown you is all well and good, but you may be asking yourself, how is this going to help me get into trades? And I'll show you. So here's the real problem that most traders have with market structure. They're able to identify these highs, these lows, these breaks of structure. They see that the market structure is bullish. Maybe they even know that this is our high, this is our low, and this is all internal. Their problem becomes, well, how do I get into a trade? And so what I see so many traders do is they will wait for the break of structure, and then they will buy the breakout. So the moment that price breaks structure in any direction, they buy. This is a very risky game because you're buying after the real move has already happened. You see, what they do is they'll buy in here. They'll set a random take profit level that has no relevance to actual price action. It's essentially just a guess. And then they will put their stop loss inside of the new bullish price leg. So from this low to this high, they'll put their stop loss in some random area inside the price leg and just hope that it doesn't get hit along the way. Or worse, what some people do is they'll extend their stop loss all the way down to the swing low down here and then have a negative risk to reward, which simply means they are risking more than they could possibly win, which is pretty much a recipe for disaster. So how can we look at solving this problem? Well, one potential solution you could look at is instead of trading the breakout, so instead of trading this break of structure, you could trade the retest. And sure, I mean, that's what many traders do, right? Instead of trading the breakout, they will wait for price to come back into a certain level like this, for example, and then they will try to buy from this level and maybe still have their stop loss in here. Maybe they have their stop loss somewhere in here. At least then you have a real target, because the whole idea of market structure is targeting the next swing high. You always need to have a predictable price for your target. So at least with the retest model, you do have a target for your price. You could get that. But again, the problem is that many people are just hoping, assuming that their stop loss will be respected, when in actuality, it's very, very easy for price to just come down here like this, all the way into here, just to go back up in here. I mean, how many times have you taken a trade just like this one, where everything looks great? You know the direction of price. You place your order, you put your stop loss somewhere to watch price go just to your take profit. So you need an actual system, a proven process to deal with these problems. A possible solution that you may use or may have seen others use is the fib tool. The Fibonacci essentially is just a percentage retracement of the price leg. So for example, if we map out our structure based on what we've just learned, we would know that this is the high, this is the low, higher high, break of structure. So we're bullish. We're expecting price to trade higher. Higher low, higher high, we're still bullish, expecting price to trade higher. So now we can map out our current low and our current high. So we expect that price will trade toward this high. That's what probability indicates with market structure. We just don't really have a way to get in. Now, one thing you could do to refine your approach is take the Fibonacci tool and then draw from the low to the high, and this is going to give you these numbers. My numbers are 0, 1, that's for the high and the low, and then 0.5. 0.5 is going to show you 50%, the middle of the price leg. And then you can add in 0.618 and 0.786. These are essentially just the golden zones, which essentially just means that there's a high probability of price pulling back into these zones through historical data. What's the big thing about this? Well, this 50% gets broken into two things. We have premium and we have discount. Now, it's a very simple concept. At any one point in time, price is either trading at a premium or trading at a discount relative to your price leg. That simply means that if it's high, it is considered premium, and if it's low, it's considered discount. And just go for a minute based off of market psychology. Everybody wants to buy when it's cheap, and everybody wants to sell when it's expensive. That is the framework that you're using. You want to be buying when price is in the discount, and you want to be selling when price is in a premium. So by understanding this, and by understanding that anything below 0.5 is discount, that is essentially what you can do. So what you can do is you can place your trade in the discount of the price leg. You can put your take profit at the high, you can put your order at the discount and your stop loss at the low down in here. At least you will have at least a 1-to-1 risk reward. If you want to go one step further, you could move your trade to the 0.618 or even the 0.786. But please note, the lower that you bring price, only by understanding just the fib, essentially lowers the probability that you will get tagged into that trade. So you may get a higher risk reward, but you'll take far less trades. So maybe you want to go for something in the middle. That's going to give you a 1 to 2 risk reward. So for every $1,000 that you risk, you'll make 2,000 if you win, and you'll lose 1,000 if you trade. That's not bad, but it's also not optimal because, again, this isn't really based on anything other than market structure. We can go one step further by incorporating something else as well as premium and discount, which leads us into step 4, the confluence key. You see, the confluence key is using other very accurate ways of reading price action and combining it with market structure to give you an edge over the market. So here's what a confluence key could look like. First, always identify market structure. High, low, higher high, higher low, higher high. Identify price range. Here's my swing low, here's my swing high. That is my price range. Now what you can do is you can set your fib, so your premium and discount, from your low to your high, and then you can find confluences that are inside of the discount. So anything that is below 0.5, that is a confluence. Now a confluence for me refers to, let's just keep it at order block or fair value gap. Now an order block is simply a 3-candle formation. This is when you have a bearish move and then a bullish move with aggressive momentum followed by another bullish move. When you look at that 3-candle formation and you take the bearish candle, the high to the low, and draw it across, that is going to give you an order block. What this means is that large money, smart money, have stepped into the market at that price and moved the price higher. This represents a very key area of confluence, an area that large money is interested in and that it has backed. So we can use this level because we understand as long as it's positioned with market structure, it has a higher probability of holding. A fair value gap is also a 3-candle formation, but in this instance, we may be looking at 3 bullish candles. So if you have candle 1, candle 2, and candle 3, you'll see that the wick of candle 1 and the wick of candle 3 do not meet each other. That gap is called a fair value gap. This is essentially another mechanism to understand when smart money have stepped into the market. Massive buyers have come in and there were not enough sellers to match their orders, which simply means buyers are dominating from this specific price point. And so if we are bullish on market structure and we see this fair value gap or this order block, that is a specific area where large bullish money has just stepped in. And so we understand that we can use that to our advantage by putting our order at that level because it is protected. So that is the confluence key. When you are bullish, you can wait for a confluence inside of the discount, and then you could use that. What this does is it allows you to have, number one, an actual reason to enter at a specific price point. Number two, a better place to place your stop loss, because instead of trying to map out the swing low, we can just put our stop loss at the bottom of the confluence, because if this level gets broken, then the trade idea is over anyway. The second thing is it enables us to have a higher risk to reward, which simply means the lower into the price leg that we can take our order, the more risk to reward that we could probably end up with. So we went from some traders who take a 0.9 risk to reward, a negative risk to reward, to a 3.76 risk to reward, which is a lot healthier. Again, this is what many traders may do. And honestly, this is something that does work. But I can take it a step further and give you something called the refinement. You see, what I've shared with you today is actually part of the progressive process that I have personally been through myself. When I was like you, a struggling trader, struggling to achieve consistency, these are the things that I was looking at. I first looked at market structure from a very basic standpoint. And then as I became better and better, more advanced, a deeper understanding of price, I became more evolved and my idea of the market became more evolved with it. So now I'm at a point where through data, through testing, and through experience, I built a profitable model, and the final step is the refinement. You see, there are a few problems when you use the confluence key alone. One of the main ones being that you'll see scenarios just like this one. We're bullish, so we have our low, our high, our low, and our high. We're bullish, awesome. We want to be looking for longs, great. We have our swing low, we have our swing high, we even have our premium and discount. The issue here is that there are two areas of interest, two confluences in the same price leg. There's an order block all the way down here, and there's a fair value gap up here. And so many traders struggle with this because the question becomes, well, what one do I use? Do I use the order block and hope that price comes all the way back down here? Do I use the fair value gap and hope that price doesn't come all the way back down here and instead trades away from this level? That is essentially a guessing game. You're left having to guess what you should do, which is never going to be what a profitable trader does. Another scenario, maybe you take both of the trades. Why not? Again, the issue with that is you're exposing yourself to more risk. So what if there's a better way? A way that we can have high risk to reward, high accuracy, and pinpoint entries. The final step is multiple time frame analysis. Multiple time frame analysis is where you view the market through the lens of multiple timeframes. What this does is it gives you a much clearer understanding of exactly what price is doing. Let's take a perfect scenario of how this could work. So imagine we have a 15-minute time frame bullish. It's creating low, high, higher low, higher high, higher low, and higher high. It's bullish, right? Now, imagine how the 1 minute time frame looks whilst the 15-minute time frame is doing that. So whilst the 15-minute time frame is putting in this high, you have the 1 minute time frame going high, low, high, low, high, low, and then it pulls back. The 1 minute time frame shifts bearish when the 15-minute time frame starts pulling back. The 1 minute time frame shifts bullish when the 15 minutes starts continuing, and it happens again and again. So with that being said, now imagine a scenario where you have a 15-minute time frame that is bullish like this, but then you're able to use the 1 minute time frame to dig deeper into what's actually happening as that 15-minute time frame is developing. So you see, every time that you get a high and then price starts pulling back like this is what is happening on that 1 minute time frame. Before that 15-minute time frame even gets down to here, this has already happened. So you can zoom in effectively to a lower time frame to get an early access preview of what's about to happen. So when you see that on the 1 minute time frame price was bullish and then it goes to bearish, now there's a high chance that the 15-minute time frame is getting ready for a pullback. On the flip side, when you're bullish like this and you have a swing low and a swing high, when this happens again and the price starts pulling back, now you wait for price to get into your confluence area. Once it's in your confluence area inside of your premium and discount, you can go to the lower time frame and you can wait for this pattern to emerge. You can wait for the 1 minute time frame to give you early access preview of when the market is about to reverse instead of guessing. And then you'll see that price in the 1 minute time frame does this. When price does this inside of your area of interest in the discount of the price leg, that is your trigger to execute and trade higher. So now what we have is an actual step-by-step plan to put all of these things together, starting with step 1, which was our true market structure. This was essentially just the way to read price swings. You want to be focusing on the outside of price, like this. Step 2 was understanding premium and discount. You don't want to be buying at a premium, you want to be buying at a discount, and vice versa. Step 3 was about area of interest, confluence. This is about identifying order blocks or fair value gaps in alignment with your market structure inside of the premium and discount. Step 4 was our multi-time frame analysis. This is refining once again. So when we are bullish and we get into the discount, into the area of interest, zoom in, lower time frame, wait for the same structural shift like this, and then execute your trade. That's what enables traders to go from taking trades that are 1-to-1 risk to rewards, 1-to-2 risk to rewards, to be able to take trades that are 1-to-5, 1-to-7. And being able to do that massively increases the chances that you can become successful because you can take more losing trades. You see, a person who has a 1-to-1 risk to reward, they have to win at least 6 out of every 10 trades they take. A person with a 1-to-5 risk to reward only has to win 3 out of every 10 trades to be extremely profitable. And that's exactly how we do it. So now let's take this plan and go and apply it to the real market, and I'll show you a step-by-step breakdown of this system in action. Here we are, Euro USD, which is the currency that I primarily trade. Now, step number 1, we need to identify our swing points. So we can just look to the left and we notice that there is a high right here, there is a low right here. We can use that as our guiding points. So we can map out our high, we can draw out our low, and from here we can see that we break structure up. So that's a bullish break of structure. Then we want to wait until we go all the way up and start reversing to identify our high. Because once we hit the tipping point of price and then we begin to pull back, that is the target. So once we get that, we have a break of structure, then we start pulling back and we put in the low, then we begin trading higher and put in a new high. Now we have a new structural range because again, we've had another break of structure. So now we have a swing high and a swing low. And now notice, in that scenario that we had right there, we had a bullish push up. And so we understand that it was bullish. We can take our fib. We can take our fib from the low to the high, just like this. And then our discount, so anything below this 50% level, and then also combine that with an area of interest. So in this scenario, there's a perfectly well-formed fair value gap, right? That comes in from here to here. That has been filled a little bit so you can refine it to this one. And that becomes your fair value gap. So you can use this fair value gap, or you can use the entire fair value gap with order block. And then you can wait for price to get into this area and then zoom in to the 1 minute time frame. Once you're inside of that level, which is just this area right here that we've just zoomed in, right? Once you're inside of that zone, you can just wait for the 1 minute time frame to give you a shift, because we know as price comes into this zone, it's going to be coming into the level bearish. And so for our confirmation, we just wait for a bullish move. And as you can see, we get a very aggressive bullish move at the beginning of London Open, which gives us our confirmation. So at this point, you could be looking to execute. And a perfect area you could be looking to execute straight away is this 1 minute fair value gap that sits right in here. You could be looking at putting your entry at the open of the fair value gap, putting your stop loss at the low of the fair value gap, like this. And then you're literally just waiting for price to take the external swing point. So you want to be looking at the swing high all the way up in this area right here. And that specific trade idea would have given you a 1 to 3 risk to reward. Instead of what a lot of other traders would have done, is they would have tried to trade straight when the breakout happens and probably ended up losing this trade. Or maybe they would have tried to use the entire area, the entire confluence on one time frame, and they would have been essentially risking all of that for a 1 to 2 risk to reward, which isn't terrible, but it just means you have to be right so many more times. But when you can really zone in and refine your system, refine where you need to take your entry from, that is when you're going to get the sniper entries. And I'm putting my stop loss in a safe place right here. I could just put my stop loss below the actual fair value gap itself and anticipate that the fair value gap holds and take well over a 1 to 5 risk to reward. But that's not the actual trade that I even wanted to break down. That's just literally one that I seen as we play this out. Dropping into the actual trade that I'm here to show you, again, you can see that price breaks structure to the buy side, has a pullback into this premium and discount area, into this area of interest, begins to range and then continues to come lower, and then eventually respects this swing low and continues trading higher, continuing in its bullish direction. Now from here, what you would be looking at is putting your fib at the low to the high and then waiting for price to come into this order block in here, right? Or the fair value gap. We can use the fair value gap or we can use the order block. And then once price tags into that level, what you would be looking for is for a lower time frame shift. But in this scenario, just to show you, things don't always go your way. You can see here that we have the very aggressive sell-off in New York session, and that marks a change of character. So price was bullish. We were putting in these lows, highs, pull back into here, higher high up in here. And now that this low gets broken, right, because this was the low that was in control of making a new high, that becomes a change of character. And so now we're no longer looking to go long. In fact, we're now looking to go short. When the next day of price action opens in London session, what we have now is bearish order flow. We have a high, we have a lower low. So we want to be looking for shorts. And now we need to identify our premium and discount. So we're going to go from low to high. And so anything above this blue box in here, which represents Asia, which is a massive liquidity pocket, anything over this level is good to trade. Now let's align it with an area of interest. And straight away, our area of interest is we have an inverted fair value gap and we have an order block. So these two areas that we have to choose from. This is the difference, right? Many traders in this scenario, they don't really know what to do. Maybe they trade this one and hope that this holds. Maybe they trade this one. Maybe they try to trade the whole thing. What we want to do is wait for that extra confirmation. It increases our win rate and increases our risk to reward. So when price heads into one of these zones, we simply head down to our 1 minute time frame and wait for our confirmation. So once we're on our 1 minute time frame, as already expected, we will be trading bullish into this level. So what we want to see is a shift in the other direction. So you wait for price to play out. You wait, you're literally just sitting on your hands and waiting for the market to show you what you want to see instead of rushing into the market. So now we have another break of structure. So we have a high in here, we have the low down here, and you simply just wait until you get this. After the new high, we have a pullback, we have another new high. So now we simply wait for this low to be broken. If this low gets broken, which it doesn't in this scenario, and then does, when this low gets broken, that is our confirmation, as previously explained, that the higher time frame has a high chance of now continuing to trade bearish. So what we can do is, when we see this, is we can just simply place our trade on the order block on the 1 minute time frame, put a stop loss at the high, and then we can target the swing low, right? The actual M15 swing low, which in this scenario is all the way down here. Now, I want to be completely transparent with you because I could make this look super beautiful. I have a rule that I take off 50% of my position at 5 risk to reward from my SMC setup. So 5 risk to reward, I'll close 50% of my position. Just from historical backtesting, from the data that I have, it makes sense. I'm more profitable when I do that. And then the rest of the trade, I'll let run all the way down here to the swing lows. So if this trade plays out, it would be half of 5, which is 2.5, and half of 9.6, right? Which is 4.8. So with that being said, I would be taking a combination of like 7.1% return, 7.1 times my risk. Meaning if I risked $2,000, 1% of a 200K account, I'll be risking $2,000 in order to gain over $14,000. Let's see how this trade plays out. Play price, you can see that price has the aggressive sell side reaction, begins ranging in this area for a while, comes back up into our entry, sits at our entry again for a while, and then begins to have the aggressive move to the downside. New York session opens, giving us with it the New York volatility. And I'm just going to go to a 5 minute time frame just to speed this process up for you, and we can see how it plays out. Does it hit partials? Does it hit the end of the trade? Play it out on the 10 minute. This would be the trade playing out. First target would get hit, 50% comes off the table, and then you're waiting for the next target to get hit, and that is your full take profit.